It's no secret that we are facing hyperinflation. You see it in the real estate market, in the supermarket, and in other areas of everyday life. Inflation can be a frightening time for most families because while the cost of goods is going up, household incomes are not increasing to keep up with the changes. But don't panic, be prepared. Inflation occurs when money loses its purchasing power over time. It happens all the time. Prices are generally higher than they were a few years ago. Consider what you would buy with $1 over the last few years. We can look at something as simple as bagels, for example. In 1980, $1 bought 3 bagels, while in 1990, $1 bought 2 bagels. In 2020, you can only buy 1 bagel for $1. We see this at the gas station and at the home improvement stores too. So $1 now buys far less than it did in 1970, and in 10 years it will purchase much less. This is because of inflation. This is referred to as money's purchasing power. We've compiled a list of the top 7 ways to stay ahead of the effects of inflation on your wallet and your buying power. Please like and subscribe to the channel to keep up to date on financial tips and tricks. Okay, let's dive in. Number 7. Keep cash in money market funds, or what's known as TIPS. While money market funds currently pay almost nothing, they are the preferred cash investment during periods of rising inflation. It is advisable to maintain any cash-type investments in money market funds or a high-interest cash account, just in case you think that inflation will be an issue for you in the future. Another option is Treasury Inflation Protected Securities, or TIPS, which are offered by the United States Treasury. These can be purchased directly through Treasury Direct in prices as little as $100. Number 6. Short-term bonds. Investing in short-term bonds is a similar concept to keeping funds in a savings account. Your investment is secure and easily accessible. In addition, if higher inflation leads to increased interest rates, short-term bonds will pay better than long-term bonds. As short-term bonds mature, investors can reinvest at increased interest rates. Therefore, it is advisable to stick with short to intermediate term bonds. Number 5. Commodities. Commodities involve gold and other precious metals, natural resources, and other mineral wealth used in manufacturing. In short, as demand rises, so do economic prices, and the cost of manufacturing to supply that need often climbs in perfect sync. During periods of uncertainty, commodities, metals, and minerals are often generally recognized as safe assets. Commodities, which do not pay dividends, are mutually independent to the traditional investments of stocks and bonds, and tend to move in opposite directions. Number 4. Value stocks. Value stocks are companies that have strong earnings relative to their current share price. They are also renowned for providing strong cash flows, which shareholders enjoy when prices are increasing. According to some statistics, value stocks outperform growth stocks throughout inflationary periods. Growth stocks, on the other hand, are more responsive to fluctuations in interest rates. Growth stocks have had a great run over the last decade, while inflation has been completely missing. However, value stocks have recently made a return. The present situation speaks well for continued growth. Number 3. Life insurance. Let's face it, no one likes to talk about it, but everyone will have to deal with it one day. That's why life insurance can be viewed as an important investment in your financial future. Since there are so many different terms of life insurance to mention, we will not go into all of them here. But the message is to understand that a few dollars a month could pay out tens, even hundreds of thousands of dollars in the event of the loss of someone you covered. Number 2. Invest in real estate. Real estate is an attractive investment option not only because growing prices improve the real estate's value over time, but also because real estate may be used to produce rental income as well. The amount renters pay each month might rise significantly just as the value of the property rises with inflation. These raises allow the owner to produce money while also keeping up with the overall price rise in the market. Real estate investing covers both indirect property ownership, such as real estate investment trusts (REIT), and direct investment in assets. And the number one way to safeguard your dollar in the time of inflation: cryptocurrency. Cryptocurrency is frequently referred to as digital money, and due to its restricted supply, it should safeguard against inflation. Similar to commodities, the rarity of the coin plus the demand to invest in such a coin can raise the value over a shorter period of time. We've recently seen growth spurts in many coins that seem to have become famous overnight. However, I must say that this is also what makes cryptocurrency an uncertain and unpredictable investment. Therefore, the decision is yet out on whether it will be a good long-term inflation cover. While some cryptocurrencies such as Bitcoin can be purchased with US dollars, others require payment in Bitcoin or other cryptocurrencies. So, that's our video. If you have any ideas, tips, or tricks of your own, please share them in the comments section below. Thanks for watching. See you next time.